All right, good afternoon. Welcome to Wednesday. It's Bill Ham. It's Real Estate Raw, as usual. Thanks for joining. This week, we're going to be talking about multifamily debt in today's market. Going to be discussing sort of looking at debt, what's going on with debt, understanding some of the structures, what are we going to expect in 2024, interest rates, things of these nature. If you're watching this in the future or right now, either way, please ask any questions. Anything you want to hear about, say, post in the chat. Any questions, comments, or any future topics that you'd like to hear, certainly put over there in the chat. Got to welcome Monica Wyndham, who is the backbone behind Real Estate Raw here, keeping everything straight and in line. Monica is age-old friend of mine as well as a colleague. She's been in the multifamily business and for a long time, as well as in property management extraordinaire. All right, today we're going to kind of talk about multifamily debt in today's market. Bit of a tough topic going forward. I'm going to start the conversation off by saying I was in the multifamily space in 2008. Been here longer than that. I've been here almost 20 years, and I have been through that down cycle, and so it's starting to kind of resemble some of that. Some of the market cycle is very similar. So I'm basing a lot of things that we're talking about today on past experience, the experience of having been through this market cycle. Real quick, I know a lot of the people here probably understand some of the basics, especially if you've been working with me. If you're one of my students, you've been following the channel here. You've probably got some of this basics down, but for people that are new or for anyone watching in the future, I'm going to give you a quick rundown on the basic concept and structure of multifamily debt, and then we'll move into some more current and complicated topics. All right, so the way I always explain this to someone who's new to the business, if you've been doing single family or if you've owned a home, cars, anything like that, there's a real big difference between consumer lending and commercial lending. Consumer lending, I'm going to put that in the category of fully amortized loans, all right? So what I'm saying is if you go out and buy a car, you buy a house, some kind of consumer product, and you get a loan, it's going to be a fully amortized loan, which means if you make every single payment, when you're done with all those payments, the loan is paid off and you own the property free and clear, like a house. 30-year mortgage, you make all 30 years worth of payments, boom, you own the house. Okay, great. Over here in multifamily, in commercial lending, we are not getting fully amortized loans. We're getting what we call balloon notes, B-A-L-L-O-O-N, however you spell balloon, my southern accent, balloon note, there you go. Anyway, so what that means is they are not fully amortized loans. So we're going to be getting loans in the multifamily commercial space that are probably going to be 3 years, 5 years, 7 or 10 in length. No rule, those are just average. So for this conversation, let's just say a 5-year mortgage. You're going to go out, you're going to buy this apartment complex, and you're getting this 5-year loan on the property, but it will be amortized out at 20, 25, or 30 years. Meaning, let's use simple math, a 20-year amortization, right? If I get a loan that is for 5 years, but the payments, the amortization is set as if it were a 20-year loan, then come the end of that 5 years, I will not have paid off that full loan. I would only paid off what one fifth of it, or 20%, right? So that's the idea here in a commercial loan. It's very different than consumer lending. It's a business loan, and that's what you have to understand is when we're out here getting multifamily debt, it's a business loan, and it's not going to be fully paid off. That's an extremely important concept because it has everything to do with exit strategies, what's going on in the market in the world today, right? If I go out and get a loan and it's, let's say, 2 or 3 years in length, and then I have to pay the bank the loan amount or whatever the remaining loan amount is in 2 or 3 years, I'm very sensitive to the exit price, right? Because that property had better go up in value for me to either BRRRR model, buy, renovate, refinance, and pull money out. And that's what we saw over the last couple of years. Everybody was getting these short-term loans doing the BRRRR model, buying, renovating, refinancing, planning to pull cash out. It worked, and then all of a sudden it didn't work. What happened? Blue note, right? So what's going on is there were people going out over the last 2 years getting loans that were too short in term, 2 years, 3 years, and it was not giving the property enough time to go up in value so that they had more value than the loan amount when the loan came due. Loan comes due, the note balloons, and that's where we get that term, right? It swells up and it's due all at once. And so the catch here, black swan of this market, interest rates. The interest rates went way up. Okay, well, now let's talk about another aspect of these balloon notes. They are what we call debt service coverage ratio loans. When you're talking about consumer debt, you are the asset, right? You're the one backing the loan. You're out buying a car, a house, something like that. It's all based on a debt to income ratio. They're going to look at your W-2 money and they're going to say, okay, the property appraised, and does this individual make enough money at work? Yeah, okay, you get the loan. Over here in commercial world, you might be talking millions of dollars for this apartment complex. No one is looking to see if you make enough money at work to pay the loan. It's a debt service coverage ratio, which means the bank is going to look at the net operating income of the property, income minus expenses equals NOI. What is the ratio of the NOI to the mortgage payment? They typically want to see about a 1.25, maybe some 1.3 sometimes, debt service ratio. So they're saying for every dollar of mortgage payment, they want to see with about $1.25 worth of net operating income. Okay, so that's the fundamentals of our underwriting and the fundamentals of how we find deals in multifamily is understanding that these are not fully amortized loans. They don't pay themselves off completely. Therefore, you are always going to have an exit strategy. And that answers another question people always ask. Why would I sell a property? You know, if a property's a great deal, it's cash flowing, why wouldn't I just hold it forever and never, amen? Well, because that loan is going to come due every so often. Now, if you own that property free and clear, no debt, yeah, you probably can hold it forever and ever. But if you have to refinance every 3, 5, 7, 10 years, something like that, then you're very beholden to the exit strategy. And that has everything to do with how you buy the property to begin with, right? And so the purchase is the gift that keeps on giving or taking, whichever the case may be. And so that's what happened the last couple of years. People were going out expecting the world just to continue going up at this outlier rate. Rents go up, everything goes up, 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 up like it did. Well, you know what else went up? The interest rates. Okay, now think about the debt service coverage ratio. If you have this property and you bought it 2 years ago for $1 million and the interest rate was 3.5%, fine. Now all of a sudden you need to refinance or you need to sell, and your buyer, the new lender, comes in and says, yeah, but that's a 1.25 debt ratio when the interest rate was 3.5%. It's 7% now. That's going to cut that debt ratio in half. Okay, how do you solve that problem? You just bring in a whole lot more money. And that's where we get to capital calls. And so if anybody is experiencing that right now, if anybody's got problems going on, that's typically what we're seeing in the syndicated world. We're seeing that with a lot of syndicators. They went out, they got short-term loans, they over-projected the rent growth, they over-raised, they got a huge acquisition fee. Now that loan is coming due, and the interest rate has risen dramatically, and they have not been able to raise the rent and keep the net operating income growth up to where the debt ratio works out. So the rates outran the rent, debt ratio falls, solution, add more money at refinance. And that's where the BRRRR model stops working. You were buying, renovating, refinancing, planning on pulling money out, and now you've got to buy, renovate, refi, put some more money in, or go into foreclosure model. And so that's where we're at in the market right now. That's where we're at in the debt market, and that's how we've gotten into the situation that we're in. That being said, it's why I think we're going to see a fair amount of distress over the next 6 months. We had over $8 billion worth of these short-term, they're called CLO loans, or short-term commercial collateralized loan obligation. That's what CLO stands for. Short-term loans, basically. Adjustable rate, interest only, what I call basically credit card loans for buying real estate. There was so much of that over the last couple of years. Why? Because it was that kind of loan that allowed the price to work. Okay, pause, sidebar, here's your lesson for today. Never use debt abusively. Never use debt to justify a deal. That's always a huge mistake. And that's one of the ways people ask me, hey, how did you know the market was going to turn? How can you tell when the market's going to shift? When you start seeing people use debt to justify overpaying for an asset, right? When you start using interest only to make the deal work, that's a huge sign that the market's getting away from itself, right? And I saw a lot of that going on. So that's why I started predicting, hey, the market's going to shift. And it did, and the rates went up. And now all these people that had these very short-term loans are all having loan maturity. November, December, like I said, we had about $8 billion of these loans come due. A lot of it got a loan extension. I'm working with a few clients right now that are in loan extensions. They got about a 6-month loan extension. You know, the loan was due in December. They've been given a stay of execution till mid-June, July, something like that. So if you're in that kind of situation, now let's get a little more current with this conversation. If you're in a debt maturing situation, if your loan has already come due, or if you have a loan coming due in the next, say, 6 months to a year, you're going to want to be really cognizant of your T12. All right, think about it this way. If you're going to sell or refinance, sell it to yourself. That's all you have to stop and think about is if you have a deal and you were going to sell it to somebody else, do the math. Would you buy the deal, right? And you got to go out and get a loan, and you got to put down 25%. You got to go get a 7.5%, 7% interest rate, 6.5% interest rate loan, whatever it is, right? Do that math. And if that math doesn't work out, then you're misvaluing your own property, and you need to start considering an exit strategy long before you run out of time. So start looking at your loan, look at how much time you have left on it. What you're going to want to achieve is a 90 for 90. You're going to want to see 90% occupancy for the trailing 90 days. That is the best loan scenario to put your buyer or your bank into if you're trying to refinance or sell. 90 for 90, so that's your goal. All right, if you've had loan maturity, let's say you're one of these people that's gotten a loan extension, maybe you're staring down the barrel of a foreclosure coming here in the near future or some kind of loan workout. All right, first comment, you're not alone, right? And I always tell people I don't really mind having a problem as long as everybody has the same problem. It's when you're alone with that problem that really kind of sucks. Trust me, I know. In this scenario, there is a lot of bad debt if you're a bank, right? You're not likely to be the only loan that this bank is having some issue with. So what you're going to want to do, step number one, is to try and be as small a target as possible. You want to turn into a little cute mouse in the corner and stay there, right? First off, understand these lenders are people. I have been through some loan workouts, through a foreclosure, through a bank takeover. I've been through all this stuff myself. And what I come to realize at the end of the day is, yeah, it's math, it's money, it's stuff like that, but it can really come down to a personal relationship. And if you're a jerk to your bank and to your lender, they might just decide to throw you on the fire that day, right? So first comment, no matter how bad the situation is, no matter how emotional you get, no matter how mad at the bank you get, things like that, keep it professional, because if you go yelling at people, you get upset at the bank, believe me, behind closed doors, they can just decide you're the one that they're going to foreclose on today. It can have a huge effect, trust me, human factor. All right, that all being said, next step, try and get your operations as good as you can. Heads in beds, right? So what Monica and I always talk about, clean, safe, affordable. Do not over renovate units right now. Do not do major projects right now. Make sure your property is in as good a shape as you can be for as little dollars as possible, right? And then to the bank over here, you're going to want to try and keep that debt service ratio as high as you can, and understand that that lender probably has other problems. So if you're not the biggest problem today, they may go focus on other people, and you may get a stay of execution. So focus on your operations. Do not over renovate units. Screen, but let's get people in those units. Get your occupancy above 90. Maintain it above 90. And that way, at least if you get to the end of this extension and you've not found a buyer or something like that, you're in the best scenario to get yet another extension or some form of workout. If you're the biggest, baddest problem that bank has to deal with today, they're going to single you out, right? And so this is how I survived some of the '08. This is how I survived some loan maturities and defaults, some of the things I've been through in my own personal career. So I'm telling you from experience, try and work this out. Keep your property going. Like I said, just keep your head down. Don't make any big waves. Try and operate as best you can. That's the best thing you can do right now. You're not alone. Get to the end of the extension. Maybe you can get another extension, especially if your property's in as good a shape as possible. Last tip, if you're having any concerns about your situation or the loan maturity, try and list the property. Sooner the better, right? It's not a great time to sell stuff, but I always tell people it's free to list. It's not going to cost you anything to list that property, right? Talk to a realtor. If they're comfortable with the price, they're comfortable with taking the listing, pick a number that you would sell the property at, throw it out there on the market. Why not? It's an option. You don't have to sell it. You don't get the number you want, don't, right? But that's kind of debt. That's kind of where we're at in today's market. Going forward, they're talking about lowering the interest rate several times next year. I think that they will. I think the overall economy is doing well enough, and that we're not going to hit any kind of major recession. But I think that some of the economic damage is going to be siloed in more of the real estate space. And I think the Federal Reserve is kind of intending a little bit of that. And they're going to, even though they're going to lower the rates some, there's still going to be damage with the lenders. There's still going to be, bad loans that the lenders have to work out. So it may not affect their attitude. And that's the ultimate point I'm getting to here is, yeah, they may lower the rate some, but the lender's still got to be in a good mood to want to do the loan. And look at office. I've been reading the papers lately, and office occupancy hit a record low. So we've just hit a new, since the 70s or 80s, whatever it was, a new record vacancy in office space, and so that is certainly not helping. I know this is not an office forum, but point being, your lender has some office loans and you're trying to borrow on multifamily. It all trickles down. So pay attention to the macro cycle, the macroeconomic market, other aspects of real estate, not just what you're focused on. Look at all the other businesses. Those are all good things to pay attention to. So that's what I have for you on debt today. If anybody is in need of consulting, reach out to Monica or myself. We've been through this. We can certainly help you out in your operations. Monica is an expert in setting up books and consulting and math, things of that nature. I'm pretty good with operations and working out the debt and things of that nature. So I do offer consulting services. You can go to realestateRaw.com if you want more information on that. I am me. Be happy to talk to you. If you have any questions, anything like that, you need any help, anything, throw it over there in the comment section or just reach out to us. Anything anybody wants to hear about in the future, let me know. Not sure what we're going to do for next week's call yet. I usually kind of like to drop this week, but I have no idea what we're going to do next week. So if anybody has any suggestions of what we could talk about, any kind of topic they want to hear about next week, that would be excellent. Could use the suggestion. All right, so appreciate it. Thank you all for stopping by. Check out Real Estate Raw. I've got about almost 100 articles in the free section over there now. So a ton of reading, a lot of different topics. Be putting those out every single week. And you can follow my newsletter on LinkedIn as well. So appreciate it, and we will see you next week. Take care.